And I'm gonna add the mic. Mic. Okay, you should have audio now. Just going to check whether we are live on YouTube. And yes, we are. Great. Okay. It's been a little while since I've gone live, and sorry, I've just been setting up the stream, and I posted in the Discord that I'd be up at 11 a.m., but I saw that there's no one in the lobby, so I'm assuming everyone is at work except for me. I'm going to make a cup of tea, so if you are not watching this live, you might want to skip until I have my cup of tea and I'm getting into this. This is going to be a very casual live stream where sometimes I like to do research before the stream. This is going to be an authentic video where I do the research on the stream. That is just because I did not have time to prepare for this stream. This is something that I want to do every Wednesday. Maybe just comment with what time of day would be good for you. Ideally, for me, it would be between 9 and 5, but maybe the time that would be best for you is when you're on the way home from work or something like that. What time of day would you be most likely to join in live? Because that's what I really want, is to have people join in live with me. So it feels like I'm doing this with someone. But today I'm just going to be doing some basic due diligence. News came out about Warner Brothers Discovery that, well, it wasn't really about Warner Brothers Discovery, but it affected the share price. And it's gotten me actually, usually I can tune out news, but this is actually getting me concerned. It got me to reevaluate the stock. When I did a reevaluation, I was more concerned about the debt than I was before. I don't think Warner Brothers Discovery is in the place that I thought it would be at this point in the year. And so I'm going to have to do a reevaluation. And so I thought I'd take you guys through that process. And I'm also changing my process. I'm constantly updating my process of reevaluation. What I want to be doing now is more accurately documenting what I expect the business to make, how much I expect it to make, when I expect it to make that money, and how likely that money is. Essentially, that's Buffett's approach, but I'm always adjusting how I take Buffett's approach and put it into a spreadsheet. Typically, I just do a discounted cash flow and compare all the companies, but I think I would rather have a more accurate assumption of what I expect to get in the future. Anyway, that's what I'm going to be doing today. Got to stop touching this table. It's so wobbly. I'm just going to make a cup of tea. And so, yeah, if you're not watching this live, feel free to skip this bit. Okay, kettle is just boiling. I am just Yeah, waiting for my tea. What I wanted to say as well, guys, a brief history on me. I got into investing when I was 19, about 10 years ago, and downloaded an account on a site called eToro. And from then I started buying things like gold and oil, and gradually learning how I could predict the markets and stuff like that. And ultimately am where I am now, where I don't try and predict the markets. I try and work out when a company's earnings are cheap to their price, and then so that I'll be getting a discount on the share price. And then also what I'm trying to do is now, on top of that, is identify stocks that where there's potential gold mines in their future. So Warner Brothers Discovery was one of those positions that I was testing this out on, but I'm also testing when I should be exiting positions, which is one of the hardest things. There's an ethos that you should just buy and hold, and there's also an ethos that investors typically hold onto positions that are losers for too long and winners for too short. To be honest, if a stock is winning for me, I almost never close it. But yeah, so this instance, I'm at crossroads. I need to check whether Warner Brothers Discovery, whereas naive when I, open the position. Okay, tea boiling. So I have here my sloth mug. Oh, wait, the camera's over here. He doesn't have a name yet, so feel free to comment with suggestions. Good vibes only. Right, so I don't really, I've got an idea of where I'm going to begin with this. This here, oh, let me share my screen. There you go. Got it. So this here is all of Warner Brothers Discovery's debt payments. They published this on their website. I put it into a chart. Some of them were like in euros and stuff like that. So I converted them all into dollars to get an idea of how much they would be paying, because they have 50 billion in debt. And so what I was kind of expecting was because the debt stretches over till 2062, inflation, purely based on the basis of inflation, these payments that right at the end, they're going to be minuscule by the time you get to the end. So if they can get past this difficult period of paying down large amounts of debt at the beginning, then they're going to be in a sweet zone in the year 2026 and stuff like that. And so one of the things that I'm contemplating is maybe I exit this position now and I buy back at like 2025. If basically they've got two red years, in my opinion, which is 2024 and 2025. What I thought would happen is in these quarters, in the quarterly earnings in 2023, I thought they were going to be paying 1.3 billion in interest payments. I think they paid more than that, so we'll check that. And this is, yeah, so this is what I'm slightly, I'm confused about. That basically they're not doing as well as I thought they would be in 2023. And I was hoping that they'd have a big cash pile going into 2024. And I'm also concerned, so right now, their earnings are higher because of the strikes, because they have the income from the films that they've released, but they aren't having to pay actors and stuff like that while they are on strike. And so they're saving a lot of money. And so technically they have a higher cash flow, and yet they aren't really profitable. And then what we've got coming up is we've got a massive, so we'll have a drought in films released by Warner Brothers Discovery. And then what I was kind of excited about, one of the reasons that I got into their platform was Netflix. Their version of Netflix is HBO Max, which now they're calling Max, which, first of all, I don't like the name, but to be fair, if it took off, having a platform called Max is all right. But I actually think HBO Max sounds good. Regardless, the plans of Max, they seem... I'm not liking what I'm hearing. One of the primary concerns is the idea of a 24-hour news network on their streaming platform. I just don't think that's going to be the thing that draws people onto Max. I think if you're going to do a 24-hour news network, that's essentially already what YouTube is, but better. And I'm a little bit... I think there's one of these things which is... let me just switch to full screen. When I was in Vietnam, they were telling me, this one guy was telling me about how a guy had paid for his son to become a police officer, and he paid something like £10,000, which in Vietnam was an absurd amount of money. And everyone was like, why would you go into a police officer job for such a low paid... so why would you pay so much for a low paid job? It's because his dad was also a police officer and knew how much his son would be earning if he became a police officer in bribes. And so I do think that there are secret revenues and opportunities that you get by running a news network that is perhaps worth more than the viewers that it brings onto the platform. That said, it just doesn't excite me. And the amount and what they're also talking about is having alerts pop up while you're watching something else. And if that's the case, just a terrible idea. That's just... I'm so against it that it's putting me off the entire platform. And so, but we do have, again, on the flip side, we do have Netflix talking about doing an advertising service with its paid subscribers. So it could be that all these shows, all these platforms are starting to realize that they need ad revenue. However, the benefit of Netflix is that they have no debt. Now, Warner Brothers Discovery, as I said, over time, their debt is going to become cheaper and cheaper and cheaper. And so I don't necessarily see it being an issue in 5 years, but right now it does seem to be an issue. So this is where I've been getting concerned. This year they had 1.3 billion due. And then in 2024, they have 3.7 billion due. And then 2025, they have 1.7 billion due. And so if I go to Quick Affairs, which hopefully I can get it onto on here. Open site. All right, Yahoo Finance. Warner Brothers Discovery. By the way, I first bought into Warner Brothers Discovery when it was just Discovery. So I had Discovery shares, and then I wound up with Warner Brothers Discovery shares, and I thought I'd just see how it goes. When I first looked at it, I thought, actually, there's good opportunity here. So I just let it run. And after the first sort of earnings, I thought maybe they paid off so much debt that I was quite impressed with how much debt they paid off in their first quarter. And I thought, wow, if this thing becomes profitable while paying this much debt, then when the debt payments start to shrink relative to inflation, then this is going to be a really exciting opportunity. So I thought, oh, maybe this is something that I could hold in 10 years. Also, I looked at how much, the incredible amount of material that Warner Brothers Discovery has. I didn't realize, but they have one of the most expansive media portfolios of all the social media, of all the media companies. So I think Netflix has 4,000 and Warner Brothers Discovery has something like 80,000 hours of content. And on top of that, I think Warner Brothers Discovery has more quality content than Netflix. yes, they got a lot of junk TV, but they have things like the Harry Potter franchise, Friends, and a whole bunch of other stuff. But the thing is, they're currently licensing those things to Netflix. Their biggest weapon would be when they stop licensing those things to Netflix and say, hey, you have to go on Max in order to get this content. The only reason they're not doing that right now, I think, is because they need that revenue. But I thought, oh, that's an exciting prospect if they go big on Max and start and stop licensing these things to Netflix, and they could be in for a lot of money. I'm a bit confused as to why Friends isn't on on HBO Max. Maybe it is. Let me have a look at that. Is Friends on HBO Max? Watch Friends stream shows HBO Max. Yeah, so Friends is on HBO Max because it's owned by Warner Brothers Discoveries. Again, I can't believe this is true. A year ago, HBO Max is not available in my country yet. This is where I feel like the platform has loads of room to expand, and in 10 years, Warner Brothers Discovery platform could be enormous. What do own TV shows? Yeah, I was hoping there would just be like a nice little photo that showed some of their biggest TV shows, but anyway. So how much, when, and how likely? And so one of the charts, this is the chart that concerns me, is what we're seeing. This is the past, and this is the analyst forecast. I don't know why analyst forecasts are predicting this line to go up, and this is what I need to work out and understand in order to hold on to this stock. Go away. Okay, it's going to make me sign into this. Okay, usually, yes, this is what I'm looking for. So we got networks, studios, direct to consumer, and corporate. This is what this is the different revenue segments of Warner Brothers Discovery. And as you can see, they are 6.7 billion in losses. And that's what that represents. I'm quite sure. Basically, the gross profit is 16.6 billion. And then all these things come out of it, and obviously in the expenses section here, the expenses are so much higher than the gross profit. So this is making me want to drop it purely on its own. Is this net operating expense, depreciation and amortization, which isn't really an expense. Sales and marketing, 2.5 billion, general administrative costs. I always find depreciation and amortization a weird one and a confusing one, but essentially where they stretch costs over several years. So if I am contemplating buying a van at the minute, the van would be $3.5 grand, and it's done 60,000 miles. So let's assume that it's going to do 100,000 miles before it crashes or before it breaks down. And so essentially every time I do let's say I do 10,000 miles a year, then it's got 4 years left in it. Let's round the van up to 4 grand. That means it loses $1 grand per year. So I purchase a car for 4 grand, then it costs me actually not 4 grand, but 1 grand a year. I just don't like doing that way of doing finances. I just think I bought a van for 4 grand and that's it. There's no depreciation. In a few years' time, maybe I'll have to buy a car for $4,000. But I get why some people like it, but I just think it's stupid. Intersegment eliminators. So the question is, what? Sometimes these segments are a bit unclear. Networks, does that include Netflix? Studios, that I presume is box office sales. Let's just have a look at how much the new Barbie film made. Made 1 billion in global box office ticket sales. Now, Warner Brothers Discovery will get a fraction of that, right? It needed to make something like that in order to break even, essentially. And so I'm sure Barbie did really well, but as you can see, the studios, the overall revenue from studios is 12.72 billion. So the revenue will be something like 1 billion of that in the next quarterly earnings. So, I mean, that is good. But you can see how these big events can barely shift the needle for these big companies. And also networks, you got to understand, is advertising revenue. Right, I've got to pause the stream. Sorry, I've got someone at the door. I'll be stopping this in a minute. Hello. Hello, coming in. Right, guys, sorry, someone at the door. I've got to pause the stream. Back in a bit.